Hello and welcome. I'm Taylor Pearson, and this is the Mutiny Podcast. This podcast is an open-ended exploration of topics relating to growing and preserving your wealth, including investing, markets, decision-making under opacity, risk, volatility, and complexity. In today's episode, we talk with Ernie Chan. Ernie, a physicist by training, is the founder of QTS Capital Management and author of a number of books on quantitative and algorithmic trading. In today's episode, we talk about Ernie's tail reaper strategy at QTS, which seeks to profit from down moves in the S&P index. We go into how gamma dealer hedging and forced rebalancing in the current market exacerbates intraday volatility in the SPX in a way that makes the S&P one of the best places for a tail strategy to work. We also go into the evolution of machine learning and how it is applied to trading strategies, including Ernie's tail reaper strategy. Finally, we jump into the appropriate ways to use Kelly criterion and how Ernie thinks about the appropriate use of leverage in a portfolio, a lesson Ernie learned the hard way. I hope you enjoy this conversation as much as I did. So Ernie, I'd love to start, one of the things you've spoken about that I find very interesting and also very, counterintuitive, is how is it possible to have an investment strategy that has an arithmetic return of zero, but that also improves a portfolio? Just to give an example of an arithmetic average, if we started a strategy on, day one with $100 of year one, then 10 years later, the ending balance of that strategy is also $100. The arithmetic average over that time period, let's say, is zero. How can a strategy like that improve a portfolio?
Well, such a strategy would need to be combined with another strategy that it is, maybe anti-correlated with, or maybe even uncorrelated with, in order to decrease the overall risk of the portfolio. Essentially the growth of wealth is a compounding process, right? It is not, we invest, $1 million on the first year, and the second year, let's say, go up 10%, become 1.1 million. But then, if it keep going at the same rate, it is compounding. It's not just going to get, add extra fixed amount of dollars every year. It's supposed to add more every year. So compounding has a very interesting effect that the compounding growth rate of a portfolio depends on the risk of the portfolio. It does not depend only on the arithmetic mean of the portfolio. The lower the risk of that portfolio, the higher the compounded growth rate. And so if your strategy that has zero arithmetic mean is applied to another strategy that has a small positive arithmetic mean, but that are uncorrelated with your first strategy, the overall portfolio may have a low risk because they are anti-correlated. So some of the fluctuation in the return are smooth out. So instead of 1 month up and 1 month down, you might get both months to be up a little bit. And that's actually better for compound growth rate. A compound growth rate depends on the fact that your net worth doesn't suddenly have a sharp drawdown. It loves consistency. It loves smoothness. And so if your return are positive every month, it beats having 1 month with a big positive return and another month have a big negative return. And that's how adding a zero return arithmetic return strategy to another strategy that has a small positive return can actually bring about a higher compounded growth rate. That's essentially the solution to the paradox.
Yeah, I find that so interesting. We talk about sometimes in terms of like volatility drag. You want, if you're able to combine two things and it reduces sort of that volatility element. If you start with $100 and you lose 50% of it, now you have to get 100% to get back to where you started. Right? Those big drawdowns are very painful. So maybe to go from there, I would love to hear just a little bit about the origin of your tail reaper strategy, sort of how it works at a high level.
Sure. So we started our fund in 2011, and at that time we were trading a spot forex strategy only, nothing to do with tail ripper. It was a fairly high frequency market making strategy in the spot forex space, and we had a great run in the first half of the year until even July. We had a great run. We practically have no losing trades, and we were very perhaps overly confident in that strategy. And all of a sudden, in the August of 2011, a black swan event happened, and that was the historical first downgrade of the U.S. Treasury debt. Never happened before in 200 plus years, and that hit us really hard. It caused 35% drawdown in our portfolio. Given that we are levered at 14 times, so we were certainly shell shocked at that time. But we were thinking, how are we going to protect ourselves from these kind of tail events that never happened once in 200 years? And we look, and we came up with this strategy that turned into today's tail ripper strategy. It wasn't called tail ripper at that time, but it's essentially the same strategy we trade today. And that is an intraday trend following strategy that trade nothing but the E-mini futures. Very, very simple. Buy when the market is already up and hope that it goes up further, and short when the market was down and hope it goes lower. Extremely simple. And we only hold position for a few hours a day. And with this simple strategy, obviously we added spells and results over the years, but that was the core idea. With this extremely simple setup, we've stood two you might call extremely turbulent quarters since then. The first one was the 2015 fourth quarter Chinese stock market meltdown, which affected U.S. equities greatly, and we generated decent return in that quarter. And then the second test was the 2018 first quarter Farmageddon, where we had the opposite problem. It's not that the economy is going poorly, it's going too well, and people were afraid that this Fed is going to increase interest rate. So, some volatility, level volatility, exchange traded product actually went out of business in that quarter because of the surge in volatility. So we were happy with the strategy, continued to run it, and of course this year we had truly unprecedented event happen. So that is the core strategy. It's a very simple trend following strategy. But what distinguishes it from other tailhead strategy is actually what we do to prevent it from losing money when the market is bullish and calm. But that's a separate layer that we apply to it using machine learning.
I guess this first one to start in terms of the tail reaper talking about, you use a trend following approach, and trend following is some variation of you buy something that's been going up, or you sell something that's been going down. I think most people think of trend following, especially in sort of the commodities future space. The CTAs tends to be longer term trend followers that are using 1 month, 2 month, year long sort of timings in terms of when they're going, how they're going long or short. I know you're doing purely sort of an intraday approach, and so it's a matter of hours as opposed to a matter of days or weeks or months. But yeah, I'd love you to just comment on sort of your your approach to sort of trend following, and then I want to get into, you mentioned the machine learning and how you think about sort of the risk element there. But maybe just start with trend following in general and sort of the approach you take and how it's maybe different from what people typically think about when they hear the term trend following.
That's right. Yeah, I mean, traditionally, yes, most CTA trend following strategy has follow a trend that has been established over multiple months. A very favorite time frame would be 1 year, would be the typical time frame for trend following. But we choose to be intraday because we also observe that trend has been getting shorter and shorter. That's one of the reasons why I think it's advantageous to have a much shorter trend following, much shorter time frame trend following strategy. But also, our trend following strategy take advantage of a certain market dislocation or market opportunity that most other trend following strategies are not utilizing, and that is the phenomenon of forced rebalancing of levered portfolio. So, to explain it better, imagine that you are holding a 3 times levered ETF that is based on the S&P 500. If one day the market goes up 2%, all of a sudden your ETF is losing 6%, not 2%, but 6% because of the leverage. And if you don't do anything, at the end of the day, that ETF will be over levered because your equity has dropped due to the big loss, the equity has dropped much more than the market value of your portfolio has dropped. So you're over levered, and as the sponsor of that ETF, you have to sell some holdings in order to reduce the leverage, and it's the same apply when the market went up a lot. So because of all these levered instruments in the marketplace, not just ETF, but many portfolio managers have the same risk management mandate. Whenever the market goes down, they have to sell some holdings. It's like portfolio insurance in the old days, in order to reduce risk and maintain your leverage. And that sort of risk management drives the market to trend in the same direction of the move. And that's what we're trying to capitalize on. And similarly, there are another phenomenon which is gamma hedging. So many option market maker or market maker for volatility swaps. Let's say a big bank sell a hedge fund a volatility swap, and then they have to hedge the gamma of that volatility swap. They also have to trade in the same direction as the market movement to limit their risk, to hedge the risk. And all these hedging and rebalancing activities drives the trend. It exacerbates the market moves. And that's what we're trying to capitalize on. But all kind of hedging like this only occurs intraday. Right after the market closes, a new day. Nobody care anymore. And so we do not expect the trend to last beyond the market close. We have to capture it intraday, and that is one of the main driver of the alpha of this strategy.
And so you think this strategy is very it is based on, for lack of a better term, a sort of current market microstructure in a way. It's part of the way in which you said like gamma dealer hedging, and then also different leverage players are. And so I guess the portfolio insurance analogy is interesting, right? You think there was a lesson that got learned there, and maybe that has that lesson just been forgotten, or what is sort of the rationale of like why things are behaving that way, why players are behaving that way on certain incentives, or how do you look at it?
Well, I don't know that the lesson is forgotten, but we have a new class of instruments that is such as the lever ETF that they have no choice but to do portfolio insurance. Its mandate is in the prospectus of the offering that they have to do it. So they have no choice.
And then I guess the next sort of area I want to get into, you mentioned that the way you approach this is using exclusively, S&P futures E-minis as your instrument. So obviously tail risk can show up in, lots of different places. It can show up in equity markets in other countries, in bonds and Forex, whatever. Why sort of E-minis exclusively? What is it about that makes sense to you, or how do you think about it?
Yes. So this phenomenon is most prominent in the S&P because of the large amount of derivatives that are tied to the S&P. There are not an equal amount of notional derivatives exposure to the DAX index or to the Nikkei and so forth. I mean, there are some naturally, but nothing comparable to that tied to the S&P. And similarly, for the leverage ETF, the AUM of leverage ETF that are tied to European or Asian indices are minimal compared to what's tied to the S&P. Even within the US market, the amount of leverage ETF tied to small cap index is much lower than the AUM tied to S&P. So it really works best in the S&P and not very well in other markets.
That's interesting. Yeah, I think I'm sure probably using this term improperly, but sort of a market microstructure function there of how sort of things evolve around the the S&P. I guess next, I kind of want to talk a little bit about, machine learning. You've written a number of books on machine learning. You've been very involved in the field, going back into the 1990s. And I want to talk sort of about how you think about incorporating machine learning into your trading approach and sort of the tail reaper strategy specifically. But maybe just to start, how would you explain machine learning, in general to someone that isn't familiar? Maybe what are some common examples, the types of problems that could be in trading or otherwise that, machine learning is good and bad at, and then, how it compares to, I think people hear other terms around like AI, like deep learning or neural nets, and those sorts of things. Because you could maybe paint just sort of a picture for how all that fits together.
Mm-hmm. So I think machine learning is a technique which allow us to examine a large number of potential predictors, whether of the market or of what the speaker is going to speak next, or or to predict whether a pedestrian is going to cross in front of a car, in terms of in a self-driving car context, right? So traditionally, in investment or in traditional quantitative finance, we use a very simple, you can call it machine learning, which is our good old linear regression fit, right? If you have a factor model, you look at price earning ratio, you look at book to price ratio, book to market ratio, whatever, 4 or 5 factors, and you try to use that to predict the return of a stock. You can say that is machine learning, but that's not the best use of machine learning, because it is only looking at a handful of variables, and those variables you already pretty much know they are predictive, right? Well, maybe not value at the moment, but we know that after careful in-depth research, many finance professionals believe that these 4 variables are likely to be predictive of future return. So you actually don't need the machine to tell you what variables are important. You already know that all you need is a actual magnitude prediction based on those 4 variables. That is a kind of naive form of machine learning, I would call it. The true important and use of machine learning is when you have 1,000 variables, and most of them you have no idea if it's going to be predictive of the future, because you cannot possibly examine, no finance professors, no matter how genius he or she may be, can examine 1,000 variables in depth to see if any one of them can predict the stock market. It's too many variables. And that's where machine learning can help, because there are established algorithms that can handle 1,000 or 10,000 variables and select those that are actually useful and get rid of those that are not, in building a predictive model. So that, in essence, is, I think, how machine learning can help both in investment and in any other field, is the ability to examine a large number of predictors.
I think, one topic you've spoken to a lot, and I think one of the reasons you went through a period of your career where you weren't actively involved in machine learning is this idea of overfitting, right? If you have, I guess the example I like is, I think there's a very strong correlation between Nicolas Cage movies released in a year and swimming pool deaths, right? So you could say, when Nicolas Cage releases more movies, you should be long swimming pool fatalities, and when he releases less, you should be, short swimming pool fatalities. But obviously, that's a spurious correlation. That's just clean data. How maybe kind of looking back at the history of machine learning in general, and as it relates to overfitting in particular, how has that changed over time? How are the approaches changed? Why does it sort of make more sense now than maybe it did in the 90s or the 2000s?
Yeah. So indeed, the way to reduce overfitting has been one of the most active research topic in the machine learning community over the past 10, 20 years. Everybody's aware of that problem. And it's not just in finance, although it's particularly problematic in finance, but the whole reason where, neural network wasn't able to be, wasn't really commercialized until the last few years is this overfitting problem. I mean, neural network is not new. It has been around for at least, I don't know, 25, 30, 40 years. is not a new concept. But it is only in the last 10 years when a technique called dropout was invented by Professor Hinton, among others, where you are deliberately punching holes in the neural network to reduce overfitting to past data, that the performance, out of sample performance, suddenly become tolerable, and the performance on business and commercial problem actually become adequate. And so, I would say most of the advances in machine learning in the last 20 years is focused on overcoming this particular problem. And for example, we started in the early days when I was in Morgan Stanley in the early 2000, or actually late last millennium, unfortunately. It was on, we like to use regression trees and decision tree to make prediction, but that invites overfitting. So, gradually people change that approach to and adapt it to called random forest, where you basically create many random trees and average them. So averaging, in an ensemble of learners is one way to overcome overfitting. You introduce randomness. Essentially, in order to overcome overfitting, you have to introduce randomness in the model. It sounds intuitive, but that is the case. That's the same as the dropout technique, where you randomly punch holes into the neural network. In the random forest, you create many random trees based on different randomized set of data in order to generate noise in the data and create models that are fitted to those noise, but you average them so that you won't be dependent on that noise. So all these techniques have been perfected or refined in the machine learning community to today, where the problem of overfitting has been greatly reduced compared to 10, 20 years ago, and become usable, these techniques. But that is for general machine learning. Of course, with respect to finance in particular, there is one realization that were much more recent, which is that if you are trying to use machine learning to predict the market directly, the chance of success is low because of the low signal to noise ratio in the market. Everybody, whether it's you a machine or human, want to predict whether tomorrow the market is going to go up or whether the stock is going to go up. And because if there is a strong signal, it is going to be immediately arbitraged away by by default. Usually you won't find a strong signal, because if it's so obvious, it would disappear. It's like the famous economist joke that if you see the market is so efficient, if you see a $10 bill sitting on the pavement, economists won't pick it up because they don't believe that it would actually exist.
So someone else should have picked it up already.
That's right. The same applies to applying machine learning to finance. Is that if the opportunity is so obvious, people would have already traded on it. You don't need to wait for the machine to find it. So one realization, one particular good application of machine learning to finance that has been talked about in the last few years, particularly by Dr. Marcus Lopez de Prado, since his book was published, was the technique called meta labeling, where instead of actually trying to predict whether the market is going to go up, we want to use it to predict whether a particular trade is going to be profitable or not, based on the trader's own past history. And that has much lower signal to noise ratio, and also that has little less fear of arbitrage, because everybody's trading strategies are different. And the machine is trying to learn from the trader's own track record rather than from a public data set where everybody can arbitrage on. And that is many people have found to be a much better use of machine learning in finance than just directly to predict the market.
I want to come back and talk a little bit about meta labeling, but maybe if you just wouldn't mind for the listeners, you mentioned sort of like out of sample performance, just defining, maybe giving an example of out of sample performance and what that, a use case or what that would mean in the sense that you're using it. And then, I'm very interested in this, like the random forest idea of using an ensemble of approaches. I guess we talk a lot about ensembles and diversification in terms of investing, but how does that just could you speak to sort of that random forest? Like what, I don't, if there's any, simplified examples that you might use in, one of your books or when you speak about it, how is that approach sort of different from what was done historically?
Yeah. So the random forest approach is essentially randomizing the data. So, originally, we have, let's say, 1,000 rows of data, and you use that 1,000 row to fit one decision tree. That's it. And, and that tree can certainly is going to capture all the non-repeatable patterns in that 1,000 rows of data. Capture every wrinkle of that data, and they think that wrinkle is going to repeat itself. But for random forest, they will what is called sample with replacement from that 1,000 row and create, let's say, 100 different data sets. These data sets are replicas of the original sample, but some of these data are repeated because you are sampling with replacement. So, the distribution of data will likely remain the same because after all, they are sampled from the same data set, but they will not be exact replicas of the original data set. So they created some noise which has the same distribution as the original data. And you will train one model on one of these replica, and another tree will be on the second replica until you get 100 trees, or train on some different sampling of the original data set. And so, and you don't trust any one of them. You will trust only the average prediction from that 100 trees. And so this deliberate introduction of randomness is able to overcome the fact that you put too much faith in the past, because now the past is no longer the same past. You have 100 different pasts, and that apparently have allowed the machine learning algorithm to not focus on some features that are unique to that data set. It will need to appear in multiple data sets for it to be picked up as a repeatable pattern. So that's how random forests are able to reduce overfitting. Now, the other thing which you talk about, which is that what about this coincidences that happened in the past and that does not just would not occur again. And in the investment context, that's a very famous, that's a very well-known problem. So, we let's say we are selecting investment managers, right? And we look at their past track record. Let's say you have 10,000 investment managers that you're interviewing to manage your investment. Well, it could be that these could be just 10,000 dart phone monkeys, and one of them, and I have done the simulation, one of these monkeys would, if you give them 3 years time, 1 year track record. Let's say you only look at 1 year track record, and you have 10,000 monkeys to try to generate this 1 year track record. One of them is going to generate a Sharpe ratio higher than 2. That's no problem. If you're looking in the past, it's very easy to find this monkey that has a Sharpe ratio of 2. Now, and that is the same problem with machine learning. If you look hard enough, you're going to find a pattern that is like huge Sharpe ratio in the past. But how are you going to make sure that it's going to perform in the future? So that ties to the out of sample test. But the problem is, in machine learning, you actually have more than 10,000 monkeys. You could have 100,000 monkeys that you're looking for the pattern. And so one specific out of sample test is no longer enough, because even with an out of sample, chances are, out of 1 million monkeys, you're still going to have one that can pass the in sample test and still do well in out sample. So in machine learning, we have this technique called cross validation, which is essentially dividing the data into many parts, and you will look at, and you will, at each iteration, you will exclude one part and leave that as the out of sample. So you essentially created many different out of sample data set, and the monkey has to perform well on average on all this out of sample data set before you will accept the model. So that is a way to prevent this kind of problem where you can essentially find a Sharpe ratio 2 model just by random. So, and that's the second advance in machine learning to prevent overfitting.
And then to complicate it even a little more, let's just say you had 1,000 random tree samples and you're looking for a high probability trade of a high expected value. Isn't it possible sometimes that given where the market's at in the current state, you could have hundreds of those random trees light up, and that exhibits a positive expected value trade for you, so you'd make that trade. But then maybe a year from now, it could be a separate several hundred trees that light up that symbol an expected positive value trade for you. So it's not like you're looking for the same random trees or the same probabilistic paths to light up. It can be different paths at different times given different markets. Is that correct?
Well, yes. I mean, typically we train the machine learning model regularly just to take in new data. And every time you take in new data or we train the model with a different random seed, when initial random configuration, you get a completely different set of models. So one test of the robustness of your machine learning strategy is that to see if the performance will vary drastically when you take in new data and retrain the model. Hopefully it doesn't.
I mean, going back to the meta labeling, is this a good example? I think about Dan Rasmussen and Verdad. Like the idea of meta labeling is like, if you just want to know if the market's going up tomorrow, that's maybe too difficult. But if you can niche down to very specific things, like I believe Verdad looks for if a company is paying down its loan structure, they can predict that using machine learning, that pay down of the loan structure. And that's where they look for outperformance of those stocks. So as a part of meta labeling is like niching down to a very specific example that you're looking for. And that gives you a broader set of where you could have a, probabilistic, higher expected value trade.
Actually, I would interpret it as a machine learning on a human constructed strategy instead of directly on the market, right? So it's not so much narrowing it to a particular niche, but it is really using private data instead of public data for learning. Because if you are applying machine learning to public data, like whether the market can go up or down, everybody had the same data, right? I mean, I don't believe that my machine learning model is better than Citadel's or better than Renaissance Technologies or better than the Goldman Sachs. No, I don't think so. So if we are all trying to predict the market go up, I think Renaissance probably had a better chance of predicting accurately where the market go up. But that's not what I'm trying to use my machine learning to do for me. I have a simple strategy, in this case, tail ripper, intraday trend following strategy. Maybe Renaissance Technology has one, maybe not. I don't care, but because they don't have my exact data that I'm going to learn from. And with that, I'm going to apply machine learning to learn from my private data, to learn whether my strategy do well or not for a particular day. And so that no one else is learning from my model, only I am. And I'm trying to only beat my own base model. I'm not trying to beat the market. I'm trying to improve my own strategy using all these features. And that has a much better success rate than if you're trying to beat the market, because everybody's trying to beat the same market. But very few people, hopefully only me, are trying to beat my own model, so to speak.
And I know you've talked about before, you almost think of it more as a, correct me if I'm wrong, as almost like a risk management tool. The actual, you're using, as you said, a fairly simple intraday trend following strategy, and then you're incorporating the machine learning as, for like a risk management, or sort of how do you think about it? And it's not generating the trade idea, so to speak. Like you said, you're not just training it on market data. It's helping sort of improve the strategy. Could you speak a little bit more to that?
Right. So, like I said, the main use of machine learning is to look at variables that you have not taken into account in your original strategy. Because in the original strategy, it's a very simple trend following, pretty much technical indicators are the inputs, right? We are not looking at non-farm payroll numbers. We are not looking at how gold performed that day in order to generate this trend following signal. But that's exactly what we should look at in the machine learning layer, because, for one thing, our model typically perform poorly when there's a bull market. because there's no tail risk to hedge in a bull market. Very low volatility. It's unlikely to have a tail moves. And so one of the variables that we would want to look at is volatility in it all its manifest forms. Implied volatility, the historical volatility, gauge volatility, whatever you can come up with to measure volatility. And and in the original model, it is too complicated to take into account all these different forms of volatility. But machine learning can do that easily. And so we will enter that, and also many other variables globally. It could be that exchange rates might affect the profitability of this strategy. It could be commodity price would affect it. Who knows what? We don't know. We don't know a priori what variables are important. So we throw it all in to machine learning, and then it will try to learn how this large set of predictors can be used to reject or accept your original model's trade. And that was what we used, I think successfully in the last year.
And so you're almost, maybe I'm oversimplifying this incorrectly, but the initial idea is just, as you said, is sort of a simple trend following strategy. And then you're passing it through this layer of the machine learning that's kind of saying like, do we want to sort of assess the position sizing or the probabilities, based on this simple model, and that we're using that to sort of adjust based on our past performance in the med labeling technique.
Yes, that's essentially it. Yes.
And then, I guess, sort of sticking on the tail approach, I think, one common conversation I've had talking with quantitative investors about tail strategies in general is, well, if a tail strategy, a tail risk event happens once every 5 years and you have 100 years of data, you've only have 20 data points. So how, how can you take a quantitative approach to, tail risk? There's just not enough data. How, would you sort of comment on that and how you think about it?
Yeah, so our strategy, though it's called a tail ripper strategy, actually trade more than what one would expect a tail strategy to trade, at least in the base model. So in the base model, I would say that we have at least a quarter to 1/3 of the days we have trades, which is actually, in my opinion, far too often. As you pointed out, catastrophe or global crisis don't occur, 1/3 of the time every year, right? So that's why, exactly, in our opinion, it trades too often. But that's good because it provides enough data point for us to learn from, for the machine learning to learn from. And so the machine learning is going to learn from this overabundance of trades and to tell us which one is actually going, you might as well skip doing it. And so after we applied the machine learning layer, the number of trades become far fewer. And so you can't really learn from those trades. But fortunately, we internally run our base model still. We still have our internal base model to run, and that generates hypothetical trades for our machine learning model to run on. And that is generating sufficient data for training.
Yeah, it's interesting. There's always used to be, it's, how far out into the tail counts as the tail. It's like, at what point do you draw the line where like, this is the tail and this isn't. But, I find people tend to get hung up on that. And then Jason, I think you're going to say something.
Yeah, part of that, I think, to piggyback on what you were saying, is that if people are trading tail risk put options, it's very different the monetization schedule of that, where when you're trading intraday, the E-mini futures, the S&P futures, you can follow that move from a small move to a big move to a huge move, and you're not necessarily, as long as it keeps running intraday, you're just trend following that move, and you don't need to necessarily monetize your positions because IV is expanded or you're worried about your theta necessarily, especially on an intraday trade.
Yes, it has a completely different profile from holding put, because holding put you are you're not putting on a trade essentially. You are holding a position. It's like a buy and hold position, essentially. Whereas here, we are on a as needed basis. If there's no turmoil, no moves, don't trade. No position and no trades. And that saves a lot of premium decay that way, especially with the help of the rejection of a trade by machine learning.
And as part of as you have that movement intraday in the market, let's just say the market's selling off and you're short the S&P. Do you have any sort of trailing stops, or do you ratchet up the stop behind as as the move grows larger and larger? Or how do you think about monetizing or getting out of the trade?
Well, there is definitely a stop because not every trend is a trend. You thought it's a trend and then it turned into a mean reversion. So when it does that, we get out. So yes, there's a stop loss for sure. But one of the, I think, crucial benefit of a trend following strategy is that there should be no limit to the upside. So for example, in the last few months, we have days that were, greater than 10% move per day. And in the past history, there are days that move over 20%, the US, the equity index. And so let's say we get into a position when the market is up 1% or down 1%, more often, down 1%. If we say, we are going to have a profit target of, just make 2% and be out. Well, as the market keeps sliding, you get out at when the market is minus 3% and you make 2%. You might be happy, but that's not a con-fact strategy, because a con-fact strategy supposedly is supposed to have unlimited upside and limited downside, but unlimited upside. So we do not impose a profit target. So if the market ended up down 20%, we will make 19%. So how do we decide to get out? Well, because of the rationale for this strategy, because of the particular market dislocation or opportunity that we try to capture, we always exit at or before the close of the cash market, because that's when rebalancing of portfolio stops. People have to rebalance by the cash market close to maintain the leverage that they are allowed to have. And so after that, nobody cares. You make money or lose money, frankly, nobody cares. It's not in the legal document that you cannot lose money after that time. so they are fine with that. And so we also exit at that same time.
Got it.
As all these are. And
I'm glad you brought back up almost that end of the day function, because when we're talking about, you brought up earlier, like creating robust models or robust ways of implementing trades. I think historically, when CTAs were fairly algorithmic, maybe before machine learning or AI, came onto the scene, is historically a robust algorithm would mean they could apply it to multiple markets. But if you apply your E-mini strategy, your S&P strategy to multiple markets, it actually doesn't work across multiple markets. And previously, a CTA would have thrown that out historically because they wanted to see it work across multiple markets. But I think what you're hinting at, and I want to maybe dive into a little more, is that because you have these certain dynamics of the S&P markets with the gamma dealer hedging or the market on close or end-of-day dynamics with ETFs, then it actually is a robust model and it only can apply to the S&P.
That's right. So yes, I have been brought up, since my days in a big investment bank. So your strategy has to apply to 52 futures and all work on all of them before we can trade it. I said I have never understood that rationale, because I believe that every market has its uniqueness. You cannot trade the corn market the same way as you trade the gold market. It just doesn't make any sense. Just look at the corn futures. They don't have a corn future every month that expire, right? Because of seasonality. How can you attack the corn market using the same model as you attack the gold market, which is essentially financial futures, not even the commodity future? So it has never make any sense to me that someone would say that this model has to work on all 52 futures for it to be considered acceptable. I have always prefer to specialize in particular market. I want to develop a special model for gold, special model for corn, special model for equity index, and in this particular case, the specific market opportunity is only exists in the S&P index, not in corn, not in gold, not in anything else. So we will exploit it. If a investor say, "Oh no, but that's undiversified," I say, "Well, you are not forced to only invest in our strategy." Right? There are lots of different strategies, CTAs, funds out there that you can invest with. Well, if you want diversification, invest in all of them. Just allocate some to this strategy, which is good at what it does, and it doesn't claim that it can work everywhere else.
Exactly. And so part of that too, before somebody else tries to run out and do this at home, because we brought up, gamma dealer hedging and the ETF structures at the end of the day. And then, I brought up market on close orders, which can come from Act 40 funds or other places, is those things don't necessarily always exacerbate the move or accelerate the move, because they can be mean reverting. Especially gamma dealer hedging can create a mean reversion scenario until you get out to the extremes when that rubber band breaks, and then it accelerates the move. So when you have all of these competing forces, it doesn't necessarily mean that move is going to trend and continue. It can also mean revert intraday on you. And I think you've talked about historically, which months have been, where maybe volatility picked up, and so you were able to get into more trades, but then it mean reverted more than was expected. But that's just kind of what's expected from the model. And, most of the time it's going to mean revert on you even intraday before we get those breakout trends.
That is very true. And so what I described, the strategy was actually kind of our first version back in 2012. As time goes on, many bells and whistles have been added. When do you get out? When do you get out early? Should you get in? More importantly, at what time you get in? Under what condition you get in? That has all been added over the years. But particularly the major advance was machine learning, which is we are not just talking about S&P market. We need to look at globally all the other markets, how they behave in recent days, before we decide if today is going to be truly a trend following day or a mean reversion day. And so, yes, so the art is not to decide when to trade, because but decide when not to trade. When do you reject the simple strategy suggestion?
And then, if you think about, I hate to use the term average, because like you'd say the average time of trade is a few hours. Do you find in the last, that changes over time, where maybe in the last year plus, you've been maybe trading primarily through the end of the day, or right into that market close, and maybe a few years prior to that you were trading at market open, and for the first first hour of the trading day? How does that change throughout time or in different markets?
We don't actually see a big move or a consistent pattern over the years. What is the best time to enter? I think that it is more of a question of what is the best regime where this strategy would work than what is the best time of the day to enter. So the time of the day to enter, we believe that we have consistently find better entry conditions, but that better entry condition actually is applicable to 5 years ago as now. It's just that we only discover it now, but it doesn't mean that it suddenly appeared now and wasn't working 5 years ago. So that sort of drift of the entry condition actually was not discernible from what we observed.
And then over the last decade or two, it looked like most of the down moves in the S&P were happening during the intraday session. And then in late 2019, 2020, that kind of flipped, and a lot of the down moves were in the overnight session. Yet you guys were able to have a great Q1 of 2020. What do you kind of attribute to this, as other managers that maybe just traded short intraday weren't able to have much as high of returns in Q1?
Yeah. So I think it is been established that the biggest part of the daily move is during the overnight session. That is nobody can dispute that. It's just plain numbers. But interestingly, however, when there is a true tail move, the tail move never stops when the regular market opens. It always going to end up continuing that trend. And that is for the simple reason that most of the market liquidity in the US can only execute, especially if you're a stock investor. If you're a future investor, maybe you can unload your futures overnight. But if you are a cash equities investor, the only way you can lighten up your portfolio in any sort of size is during the regular trading hours. And so when there's true panic sets in, and when portfolio need to really rebalance, it has to happen in the regular hours. And we don't care that on average, yes, most of the return happened overnight. We only care that on those severe panic moments, they are offered to be captured, they're trained to be captured during the regular trading hours. And because we are levered, we are not trading with 1 times leverage on the S&P. We're trading about 4.5 to 5 times leverage. A little bit of return during the regular hour, even if only 1/3 of the moves of the daily move happen during regular market hours, whereas 2/3 happen overnight. Because of that 5 times leverage, we are going to recover the entire daily move and more than the entire daily move because of our leverage. So that's how we can capture this high return despite only trading a few hours a day.
How do you think about, you mentioned earlier the Forex strategy you're using in 2011, maybe the Kelly optimal leverage was 14x or so. I don't know if that was the Kelly number, but I guess the idea of Kelly criterion is very interesting. Obviously, in like a game like blackjack or roulette, post something where the odds are known, it's a lot easier to sort of employ that strategy. Talk to poker players, for example, often say like, well, I use Kelly, but I use half Kelly because maybe I don't, there's some things that I can't predict. And so I don't know the exact odds. And I'm not able to do it. And I've seen, many investment traders be like, oh, you should run this at, 20x leverage is the Kelly optimal approach. But how do you think about, I guess, just what the appropriate role of leverage is in general, and then maybe as it relates to Kelly or whatever else you used to think about it?
Yeah. So I think when one apply Kelly formula to a continuous market like finance, there's a big problem in what distribution we assume. If you assume normal distribution of returns, Kelly typically come out to be a very large number. If you trade and you think that the returns of your trades is normally distributed, and you had some edge in your trading, you have maybe average return 10%. Your Kelly formula will be your Kelly leverage will be very high, but because it is based on an erroneous, unrealistic distribution, there are some trades in your strategy or in the underlying market that is going to be outliers, 6 sigma, 10 sigma, maybe 20 sigma, and those are not taken into account by Kelly formula. And so that gives you if Kelly formula, for example, to take into account these 10 sigma events that happened this year, and it would have it would not assume a leverage greater than, I don't know, it cannot possibly have a leverage of greater than 10 because that would immediately bankrupt the account. If a daily move is 10% and you leverage 10%, you're done. At the end of the day, you wipe out. The account is zero. So and if you look at historically, I think during the Black Monday, I think in 1980, 89 or 87, the market moved 20%, dropped 20% in Monday. So if you take into account those days, your S&P strategy cannot be levered more than 5 times. So clearly, just plugging a continuous, plugging a Gaussian assumption into Kelly formula lead to disaster, and that's what I've learned over the years. So what we do now is to always look at the worst day in history that this strategy can happen, and assume that it can be, probably 2 times worse than that, right? Whatever you observe is the worst, it's not the worst. The worst is really in the future, and that will be probably 2 times worse than what you have seen so far. And that really is the limit that that really sets the limit of your leverage.
It makes me wonder, though. We think about the origins of Kelly criterion, and it came from a Luddick or aleatory environment. I mean, casino games, dice throwing, etc., where you knew your return, you knew your variance. But when we apply that to markets, I mean, you can look at your backtest and you can know your return and your variance. But like you were just alluding to, you could see a 6 sigma or 20 sigma event that's not in your backtest. So can you really apply it to markets on a walk forward basis when you don't know your return, you don't know your variance, and you don't know your absorbing barrier? are we fooling ourselves, or by the additions of, if I change my worst case drawdown and I put a stop loss there, are we bolting on too many things to Kelly where it's no longer Kelly? Is that a fair comment on trying to apply Kelly's criterion to a infinite game versus where it was meant to be applied in finite games?
Yes. So for me, I regard the number that come out of Kelly criteria, whether you assume a Gaussian distribution or some more sophisticated fat tail distribution, take your pick, as the upper limit of leverage. Okay, so if you should not lever anywhere near that. Preferably, you are going to be half or even lower. So that is sort of the maximum. It establishes the maximum, which is good, right? We want to know the maximum. Because amazingly, there are certain lever ETF out there that plainly exceed the Kelly leverage. I have written a blog post some years ago already. I say these ETF are prime for extinction because they have plainly exceeded the Kelly leverage at 3 times. And sure enough, some of them have gone out of business. So, so that is sort of a sanity check. So we do not use Kelly leverage nowadays. When I was younger and more naive, I use it, but no longer. We no longer use it to set our leverage, but we do look at it to set our maximum leverage. If our leverage is higher than what Kelly suggests, definitely something is wrong with that leverage.
That's a great way to think about it. Because once you get past full Kelly, it's just a matter of time before you're bust or bankrupt. So, but that leads me to something I think about far too often, right? That's always on my mind and I think that you have to work with this as well, because not only do you have Tail Reaper, you have other strategies like your VIX timer and combining them into Chimera. And so you can kind of apply Kelly and look at Kelly when you have mean reverting strategies, when you're, doing a short volatility strategy with VIX, and that's more of a mean reversion strategy. But then when you combine it with a divergent strategy, like a trend following strategy on Tail Reaper, the math kind of like no longer applies. So it's like, so I'm wondering how you discretionarily, because when you have in your own personal commodity pool operation, you're combining multiple strategies. So I'm just wondering how, you have to almost take off your math hat and your machine learning hat, and you have to start thinking discretionarily about worst case scenarios, or how do I combine 2 strategies where one might, if I can maybe not Kelly, but maybe I use kurtosis or Clichy curves, and I have an endpoint for my absorbing barrier, I can get a better idea of that mean reverting strategy. But then I have to pair that with like a Tail Reaper strategy that's divergent and may not trade for months, but then has huge convexity in its returns to balance out the mean reversion. I'm really curious at how you think about, combining these convergent and divergent strategies into an overarching portfolio.
Yes. So, clearly the first concern that we would have in this combination are that whether the tails, whether overall portfolio is still convex, right? So that's an overarching concern. But just because the overall portfolio is convex doesn't mean that it has a attractive mean return. So after we sorted that out, after we imposed a constraint that it has to be convex, we now need to work on increasing the average return. And that's when we add other strategies, such as short volatility strategy. But you do not add so much short volatility strategy that it overcome the convexity of the overall portfolio. So that's how we look at it. And so whenever we add strategies, we always keep an eye on whether the it neutralized completely, or the tail hedge property of Tail Reaper, and we keep the allocation below that, based on, for example, historical track record or even backtest.
With what you just said, I wonder too if a lot of times when you combine mean reversion and divergent strategies, especially if you have the convexity on like the Tail Reaper or divergent strategy, is it wrong to kind of assume that you would net out that like that 1 over 1, like the divergent strategy with that convexity is always going to overwhelm the mean reversion strategy if combined in the right proportions, but you don't have to necessarily worrying about them negating each other as much, as one has much farther to run and can accelerate into that convexity?
Well, yes, if you're running a mean reference strategy, that is true, because mean reference strategy, it can lose money, but it's usually you can apply stop loss, or you can delever a mean reference strategy if we start to run into a long and deep drawdown. But there are short implied volatility strategies, short option strategy that can actually explode many times to the downside. So, and we need to keep a close eye on that not to over allocate to those, even though it might have an attractive return during the bullish months.
Yeah, so I should have clarified a linear mean return reversion strategy.
Yeah, linear. That's right.
That combination is the key.
Yeah, linear we are okay with. Yes,
yeah, exactly.
Yeah. Well, I think, Ernie, that was great to speak with you. Covered a lot today, but just for anyone that's interested in learning more about you, or QTS or Tail Ripper, what's sort of the best place for people to get in touch with you or find out more?
Well, I have the fund has a website, qtscm.com. That listed all our track record and some educational material. But actually, I also write books and publish many articles and papers. And the best place to get the entire output that I have, publicly available, are my personal website, epchan.com. So that has everything. It has links to all the things that I'm doing, and it's a good place to start.
Great. Well, thank you very much, Ernie.
Thank you, Taylor.
Thanks for listening. If you enjoyed today's show, we'd appreciate if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutiny Fund, you can go to mutinyfund.com. For any thoughts on how we can improve the show, or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com, and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm @TaylorPearsonME, and Jason is @JasonMutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.